Okay, thank you very much, everyone, for joining this afternoon or the early evening. We're going to talk a little bit today about the facility management business planning process here for the level 1 associates. Quite a bit to cover. We're going to try to keep it condensed but on point. And I guess I would like to say, how do you any large amount of information, I like to say, how do you eat an elephant? It's one bite at a time. So we'll get into it. And so really the PGA business planning model, you'll notice when you get into the slides and the material that comes with the course, there's 5 different phases. There's define the business, and define the business really is what are we? Who are we? Assess the current state of the business. Develop business goals, objectives, and related strategies. We're going to prepare financial forecasts and budgets and monitor performance. And I guess before we take a deep dive, I'll do a little introduction myself. My name is Jeffrey Brothers. I'm in level 2 here at the PGA Associate Program. Come from a little bit different background, similar to Tom, who's on the call. I came into the PGA from a hospitality background. I was a chef for 20 plus years and decided to do this after 20 years. And also I have a background, I have a master's in business. So if you have any questions that you want to email or send along later, I can look at the business planning model from a couple of different areas. So why business planning is important? We got to get financial goals. You can be the best golfer in the world. You can be the best head pro in the world. You can be the best director of golf in the world. But unless you can make money, the business is not going to succeed. And the second reason why it's important is service goals. You want to see new trends. You want to see customer satisfaction, employee engagement, and also you want to please your investors. I like to say, really, when you're in a management or leadership role, doesn't matter if it's the golf industry or any industry, there's always going to be 5 things that are always going to follow you, and that's product cost, labor cost, customer satisfaction, employee satisfaction, and health and safety. Those things are going to follow you everywhere. It's kind of translates across all business, no matter what business you're in, whether it's golf or anything else for that matter. So when we look at phase 1, you're going to define the business. And when defining the business, why are we here? So what are the customer's expectations? Who are the customers? Who's coming? Who's coming to the course? Are we a private course, member only, with very limited, member guests, or it's a public play? We want to know who's coming, what's the demographic, and why are they coming to see us? What drives us? So why do we exist as a business? Are we here? Are we a driving range? Are we a here to be a boutique club with a very high initiation and annual dues? Or once again, are we a public facility? And which leads into how do we make money? So what are our core offerings? So when I say core offerings, every golf course, of course, it's going to be, the green fees or the monthly dues. The core offering, if you're a golf course, is the golf course. Secondary, you might as well have a golf academy. You might be a partner with one of the big, companies and have a fitting program at your course. Those are kind of your core, what makes the most money. And also, food and beverage. Do we have a restaurant or a banquet facility? Do we run weddings? How do we make money at our facility? The description, what do we have to offer? So at our facility, once again, are we offering catering? Are we offering restaurant service? Are we offering academy, junior programs, development programs? So you want to look at as well when defining all those come into play. And as well, when you're defining the business, it's a market analysis of geographic location, customers, and competition. So really, who are we competing against? Are we in a rural area where our golfers have to make the drive to come see us? Or are we, are we downtown, I'll just, because I'm in Carlsbad area, downtown San Diego, are you Balboa Park, because everyone coming local can some, clientele walk. Knowing your geographic, location and your customers really gives you the ability to really look at where you're going to aim your marketing and what services and products you're going to offer in addition to the golf itself. So when you're defining the business, we look at vision, mission, and values. And you see on the slide here, there's some page numbers. These are, where you're going to find this information. I know the manual is quite a dense, booklet. So to give you a few page numbers here for references. So vision is where do we want to go? It's aspirational. Where do we want to be? Do we want to be the best golf course in Southern California, or do we want to be the first class service for all of Arizona? So vision is aspirational. You're not there now. It's where you want to go. And then you got the mission. The mission is how do we get there? So we want to be the best private club in Southern California. And how we're going to get there, our mission would be we're going to provide, sincere personal service. We're going to provide first-class facilities and a driving range. And we're going to, hire, the best employees for our operation. It's a mission. It's how we're going to get to be the best. When you're creating these in the assignments, they want to be concise, believable, realistic, relevant. And to think about a vision, it's evolving. So you don't want to write a vision that no one can remember, because the vision really drives the culture of your employees at the business and in your assignments as well. So it's got to be believable. When people read it, they want to be able to remember it. If you look at some of the examples, there's a few examples in the material, and you read them. And if I was an employee of that organization, I might be like, that's kind of a long thing to remember. So keep them concise, to the point, and realistic. Evolving, you set your vision, and it's usually 5 to 10 years down the road. And once you come close to achieving it, or achieving it, I guess, then it's going to evolve and maybe a new vision and a new mission. And then in addition to that, it would be your values. The values are going to be the business's core beliefs. So values similar to yourself. What are the values of the business? We're going to be, customer focused. We're going to be sincere. We're going to be engaging. We're going to be honest. Usually they're character defining words, and they can be applied not only to the business, but when you look at values of yourself. I think most of us as employees in the golf industry probably like to align our values to a business that has the same values that we want to work for. Also, the values, once again, define the culture of the business. So then you look at strategic planning and goals when you have you're defining your business. So you got your long-term goals, and we're going to come into this. I'll bring up one of the assignments when we come to tying this together at the end of talking about phase one. Long-term goals, 3 to 5 years. So goals that you're not going to achieve right away. They're not going to be operational right away. Goals that you say, okay, in 3 years, we're here right now, and this is a major goal that we want to be in 3 to 5 years. They're going to support future business plans and kind of tie, your vision and mission and values together into financial goals. You have your short term. Short term are 1 year. So the more business objectives, your budgets and forecasts, your current state of business. These are all short term. So short term could be your annual budget, your quarterly, your monthly. It's anything less than really within that 1 year time frame. And within those, which will tie into one of the assignments, you'll see goals. Goals are the smaller, I guess, jumps in the road that you achieve to get that short-term and long-term goals. So it can be monthly, it can be weekly, it can be quarterly, biannually. So goals, and they can be financial. Most are financial, or they can be service-orientated, and you'll see that in the assignments as well. When really defining the business, who are the customers? Where do they live? How old are they? How much money do they make? What are the race and gender? If you see slide 8, the level 1 seminar notes, you'll see, there's a whole example, or a lot of examples of really what demographics are or could be. So really, you want to figure out when you're creating a pricing structure, when you're creating your budget, how much we're going to charge for green fees, or how much are we going to increase our annual dues. You need to know, well, what's the disposable income? Who lives around us? Are they, are they white collar corporations around us, or are they the blue collar, industry around the golf course? So it's really defining your pricing structure, who you're going to attract to the facility itself. So recap of phase 1, and I hope I'm not moving too fast. I got about 30 slides. I think most of the time we're being here for an hour, so we'll try to keep it within that. So recap of phase 1, really when you're doing that first assignment, you want to look at the vision statement. Once again, it's aspirational. It's where we want to be. You want to look at your mission statement, and that's the steps that you're going to take as a leader when you're developing your business plan on how you're going to achieve the vision. So mission, it could be 3 or 4 steps that you're going to take to get there, and they tie into the vision statement as a whole. Your core values, it's really how you want to be defined as a business, how you want your employees to be seen from your customers, and how you want your employees to be seen by themselves. Really, they define the culture of the business. You look at a detailed facility description. So, once again, coming back to what are we? Are we a private course? Are we a public course? Are we a semi-private resort? It really defines really your pricing structure, your hiring, your level of service that you're going to offer. How many, you want to look at how many employees. Let's say you're operating a dining room, and your facility description is fine dining. Well, you're going to have a higher level of employee to customer ratio, as opposed to maybe you're a relaxed casual atmosphere pub at the golf course, when you're going to have a lower employee to customer ratio. What are the core business areas? And once again, that would be how do you make money? So how does the business make money? Those are your core business areas. As a golf course, once again, it's going to be your green fees or monthly dues or annual dues. If you have a driving range, it's your driving range is usually one of those. And if you have a restaurant and banquet facility, it's food and beverage. Those would be the core. And I guess if you have an extensive pro shop as well, yes, it would be your retail would be a core business area as well. And finally, your market analysis is, so we create our vision and mission. We define who we are as a business, and we're going to decide how we're going to make money. And after that, or I guess in addition to that, we got who are we selling this to? So we need to figure out our clientele and make sure that what products we're offering align with the customers that are coming to our facility. And so if I were to just step out of the slideshow here, and I bring up activity 1, which hopefully everyone can see on their screen. And let's see, we'll make this. So activity 1, you look at, defining the business. For instance, I picked Summit Valley Country Club. And please, like I said, I'm sharing this as an example, just so you get an idea. There's some core values, kind of aligned with myself and what I believe, a company that I want to work for, as well as, if you're doing the public facility, could be the same values. Vision statement, once again, clear and concise. I put to the leading private country club in the United States, providing memorable golf and leisure experiences. So very concise, can be remembered easily. Facility profile, you can, I'm not going to go too much into that. You can see all that from the information within the presentation slides that are provided in the materials. And so, you get a little bit idea of a breakdown when you start getting into the really defining who you are. And as you can see, there's a few examples. What are the amenities? There's a swimming pool, there's aquatics program, there's locker rooms. And the rest here. Mission statement, once again, come down to deliver the ultimate private golf club experience for members and guests by providing sincere, personalized service, creating a welcoming, inclusive community, and enhancing loyalty through memorable golf experiences. Short, concise, to the point, and really, easy to remember for your employees. So that's kind of the core of that assignment. And so I'll move on to phase 2. So phase 2, when we're going to look at, we got to assess the current state of the business. So there's a couple of ways to assess the current state. Data analysis is big when we look at the business. And within data analysis, there's quantitative and qualitative information. Quantitative, if you were to think about it, it's hard data. So it's your number of rounds, it's your breakdown of your demographic in numbers, it's your revenues, it's anything numbers that you can, it can't really be argued, it's there. So quantitative, for instance, those page numbers you see on the screen, those are quantitative. You can't really argue that. That's where you find data analysis, page 47 to 50. Qualitative is in written form or verbal form. So really, if you get feedback, just say one day you had slow play on the course, and your golfers come in and say, it was really slow today, and just to let you know, if you could have a marshal out here next time, that's really qualitative. Qualitative is customer surveys. Qualitative is reviews. It's feedback. It's Yelp reviews. It's surveys. If you're a member club and you send it a member survey for your members, that would be qualitative. You're going to use that. So within the when you're conducting an analysis, for instance, in the PGA model, they use a SWOT analysis. SWOT standing for strengths, weaknesses, opportunities, and threats. And the support materials 47 to 54. SWOT, is just one of many really analysis tools you can use. I would say it's the most, I don't want to use basic, but the most introductory, I guess, and easy to understand. So you have your strengths and weaknesses. Strengths and weaknesses are internal. So when you think of internal, strengths are qualities that the operation or the business possesses that you do really well, and your competition can't really, take that away from you. Just say you provide the best service, or you have the best manicured golf course, you have a driving range that is always on grass. That's a strength. You have a player development program. Those are internal strengths. Weaknesses, internal as well. Weaknesses, you might just say you had some key employees leave, and service has maybe taken a hit. That could be a weakness. Once again, strengths and weaknesses are internal, and you can have control over them or influence over them by decisions made internally. And when you do the SWOT analysis, you got opportunities and threats. So opportunities are, both these are external. You can't influence a lot of them from internal decision making, but you can look how you can capitalize on an opportunity through decision making. I know that sounds kind of like it contradicts itself, but an opportunity is something that exists and you can go after. And a threat, so threats really, for instance, if you have a pro shop, and you have a well-stocked pro shop with merchandise and clubs, and you have one of these big golf shops open, maybe 2 blocks away, that would be a threat. There's nothing internal that you can do to take away that threat, but maybe there's something you can capitalize on your strengths to mitigate that threat. And if that makes sense. So really, the SWOT analysis, it's a starting point, for really developing goals and objectives and strategies and how to achieve them. And really just what we spoke about there was strengths are what does the business offer, or does better than the competition, and you really have control over. And the weakness is, where the business is experiencing challenges or falling short. And once again, you have control over. You can make a decision, leverage your strength to help mitigate the weakness. Opportunities and threats. Opportunities, where you're looking at really where can the business excel. An example in the golf industry just happened last week. Callaway, the mines at Callaway looked and they said, well, we got this company called Topgolf, and this company really is cutting into a lot of other driving ranges, business. They got an amazing product, and they're expanding. And so what did Callaway do? They bought them. That was an opportunity. They saw that and they bought it. And now Callaway is just not a club and apparel company. They're an entertainment and an experience company. I'm assuming that the deal will still go through, with all the investors, and really it's opportunities. You want to capitalize on opportunities. So when you're looking at you're building your SWOT analysis, look at the opportunities within the case study of the business model, and decide whether you picked the public or the private course, what opportunities you're going to try to capitalize on to build your business. Threats are, what are the competition, who are the competition, what they're doing, and really you can't control them, but you can help mitigate. You can help work on your opportunities and your strengths to mitigate threats. And you want to look at that once again when you're establishing your strategies and your objectives. When we start building the budget, is you look at for both courses perspective, what's going to threaten our business as the as the leader, and while we're writing our business plan, so how are we going to capitalize to mitigate that. So when looking at phase 2, once again, is quantitative and qualitative data. Quantitative, usually associate data with quantitative because data is numbers. Qualitative is usually verbal or written, or it's feedback. So quantitative, think of that, it's hard data that you can show your leadership team, or you can show your investors, here's how many rounds we did, here's how much money we generated, here is the percentage of tee times that we filled compared to the amount we have available, right? So you can set your goals on that. And then you're going to create your SWOT analysis based on the observations. And if I were to bring up, I know, let's see here, number 2, activity 2, financial forecast, foresee. There we go, activity 2. So if you can see that on your screen, you're looking at, for instance, I did Summit Valley, and really I took down, some of the financial performance. So this is quantitative data I looked at, and looking at here are some of the highlights. And for instance, you get into SWOT analysis and you look at the strengths. And so we look at different areas of the core offering, or where we make money, and where are the strengths in that, so that you can see how those tie in. This is where the company or the golf course succeeds. Weaknesses, there's a few examples that I found. Depending on what golf course that you choose, you might find some different objectives to look at. External, you want to look at some of the positive opportunities, and in the for Summit Valley, and also for the the other course, to look at what opportunities exist. And then threats. Threats are, they come from demographic, they can come from the market, they can come from competition, and there's some threats, for instance, that I found. And, please, there's some examples, and you're going to find some examples as well. So moving on to phase 3. And it looks like every time I go back to this, it goes back to the beginning. So phase 3. So phase 3, so we define the business. And we said, well, here's how we're going to make money. And then we assess the current state. And we said, well, in order to make money or provide the best service or provide the best product or, provide these offerings, we went into phase 2 and said, well, we need, where are we? Where are we in relation to where we like to be, and where are we now? And so once you take a look at that, and I always say you like to take a look maybe 10,000 feet up, look at the business as a whole. Phase 3 is you got to develop business goals, objectives, and related strategies. And this is page 55 to 64 in the support material. So you got your goals we spoke about there in phase 1. There's the long term, they're 3 to 5, and short term, 1 year or less, and operations. So usually operation goals are 1 year. You got monthly, quarterly. You can have even a weekly budget, depending on the operation and the objectives that you're creating. For the golf course that you're pursuing within the assignments, whether it's the private or the public. Goals, SMART. This is emphasized a lot, not only throughout the assignments, but you might want to remember this, for the exam. Just a little hint. Specific. The goal, you want to be clearly stated. You don't want to have any ambiguity. The goal is to increase sales from 30,000 a month, or retail sales from 30,000 to 35,000. It's specific, meaningful. It's got to support coming back to phase one, the long-term vision. So, increasing that, so 30 to 35, increase it by 5,000, whether you express that as a percent or express it as a fixed number value. It's specific and it's meaningful. It's supporting the long term and making money. It's got to be achievable. If I said I want to increase annual rounds from 45,000 to 85,000, well, is it achievable? Not really, but also the next one is not really realistic. So this ties in when you're creating your budget, which will be we'll look at, is that, are these, can you achieve it? So what's realistic? You want to look at really the forecasting. You want to look at the previous years. There's the vertical and horizontal analysis that, come later when doing that. So you want to look at what has the trend been over the last couple of years, and one, can you achieve this? And two, is it realistic? Time orientated. It's got to be, once again, it's got to be a set time. When are you going to achieve it? Are you going to achieve it by the first quarter, the second quarter, fiscal year end, calendar year end? And, as you know, calendar and fiscal sometimes aren't the same. Calendar year end is December, but your fiscal year end might be June. So you want to be very specific. If you're creating a annual goal, you're not going to say you want to achieve it by December if your fiscal year end is June. And so once again, that you'll see this pop up in a couple of different areas. You'll see it pop up, for instance, in I don't want to segue, but the career, the career section when you're creating your CV and resume. Once again, SMART goals as well. Objectives, objectives really answer the question, how are we going to achieve the goals? So you made these SMART goals, and you made sure they're specific, and you made sure they're meaningful, achievable, realistic, and you're going to achieve it in a certain amount of time. And how are we going to achieve them? That's the objective. They're usually annual or fiscal year end. You could have quarterly objectives, and you could have, biannually objectives. But either way, the objectives are, so we set these goals, now how are we going to achieve them? Strategy, like it says here, it answers the question, how will we achieve the annual objectives that support the short-term goals? So everything piggybacks on each other here. So the strategy, here's the strategy we're going to implement, whether it's financial, it's going to affect income or expenses. So are we going to implement it and it's going to cost us money? Or are we going to implement it and somehow we're going to bring revenue in from this? And this is going to work into the objective, which supports the long-term goal or even short-term goal. Is it operational? Do we have to change the way we, change the way that we communicate to the starter? Or is it we are going to change the way that we park the golf carts in the cart barn because we get more carts in and we park it a certain way? That's operational. So operational affects daily operations. Or is it promotional? Promotional is how the business positions itself in the market. So promotional marketing, for any of you who have a marketing background, it's product, place, promotion, price, right? So promotional, how do you position yourself? Whether you use social media, do you use print on paper? Is it emails? Is it you might have a text message that goes out to your clientele. So how are you going to get this strategy to work? You want to increase your rounds, or you want to increase your revenue by a certain amount? Financial is okay. We're going to implement a marketing program, marketing calendar for the year that's going to drive promotions. And so the promotion is we're going to do a 9 and Dine every Wednesday. And financial, we need to spend some money to do that. Operationally, maybe not a big impact, but that's maybe a financial and promotional when looking at that strategy. So we're going to recap phase 3. We're going to create meaningful goals that support the business's vision. And you got to support those goals with objectives. And then the objectives are achieved through strategy. So the strategies are either financial, operational, or promotional. And if we were to look at, if I get out of this, and I were to bring up activity 3. So once again, I picked Summit Valley, and depending on which one you picked, there was Crescent Ridge. So I said, I'm going to increase the golf memberships by 15% over the next 3 calendar years, resulting in a total equity membership increase from the current 304 to 349. So I have a specific goal. It's measurable because I have quantitative data. It's pretty achievable. 45 members over 3 years, 15 members or 15%. And it's, I can measure it in time. It's 3 years. And I can also, if I wanted to break it down even more, I could break it down how many I want to achieve each year. And you'll see here in the assignment itself, I broke down the rounds, of the membership objective. And here's how many rounds I want to achieve. Here's my strategy. Here's my second strategy. A second, what I wanted to, my objectives, I looked at my weakness and saw, tournament rounds were decreasing. So I want to increase my tournament rounds. And I put a strategy A and a strategy B. So when you're doing your assignments, whether it be Crescent Ridge or Summit Valley, look at the areas, really you're looking at building on your strengths, but also weaknesses where you can improve. Then look at realistic strategies, how you can achieve those objectives, which lead to the big goals. I put a merchandise one here as well. So once again, those come back to how do we make money? We make money through rounds, we make money through tournaments, and we make money through merchandise. And then I picked a fourth one, which was, I created a new objective. Whether you do that or not, it's up to yourself. It's really, once again, when you define how you want the business to look, it's aligning all of these strategies with the objectives, which come back to your end goal. And the rest is more all writing. These are all going to support your goals and objectives. And so we're going to move on to, and I hope I'm moving not moving too fast here, but once again, I don't want to keep everyone too long, but also I want to make sure that at least to get, try to get, I'm not sure, I come from Canada, we have the Coles Notes. I always say the Coles Notes when you didn't want to read the book, you just got the short version. So I'm really just trying to give you the core information you need to succeed in completing the assignments. And once again, afterwards, if you have any questions regarding, I think my email is in the link that was sent by Bryce and Tom there, and more than welcome your questions.
Jeffrey, we're about 4:40 right now, so we've got about 20 minutes left, just to give you a reminder there.
Certainly, yes, sir. We got phase 4 and then phase 5, so we should be finished just around 5 or just shortly after.
Just if there's any questions along the way, feel free to let John know or unmute yourself and ask Jeffrey, so it could be more interactive if you have any questions, or if not, you can just wait till the end.
Yeah, at the moment there are no questions, Tom. Jeffrey, really marvelous presentation, Jeffrey. Phenomenal, encompassing every aspect of club management. I mean, you're talking about personally me. I mean, you're talking this whole presentation. You're talking directly to me. Want to commend you for the efforts and the detail and the research and study that you put into this presentation. It's really going to make a great reference guide on the website when associates are looking for visceral data on this book. Phenomenal, really great work.
Thank you.
Yeah, no written questions from the 3 attendees. I think I mean, it's all very clear and detailed and laid out. Truly, I want to say this is probably the most prepared and most in-depth presentation we've seen thus far on the Launchpad. And just so you know, Jeffrey, it says Bryce, but it's me. It's John Kulo.
Oh, John.
Yeah, I'm sorry, and I should be going in and changing his name to mine when I do that. Bryce, it's his account with GoToWebinar, and I just get lazy and I don't change it over. But at any rate, phenomenal work, really.
Well, thank you, John, and for the 3 attendees that we do have, thank you so much for spending some time with us and me. And I hope you get a little bit out of this. And once again, you got any questions, please chime in. Anyway, this is phase 4. Phase 4 really is I'm going to say the biggest chunk of the assignments you're going to have to complete. There's kind of a 2-phase assignment of this. One is creating the operations expenses, revenue versus expenses, and then the budget, the annual budget throughout the year. So really, I don't want to rehash everything that went. Obviously everyone that's here has attended level 1, but there's really some key metrics that you're going to see in the assignment. Rounds versus yield. Really, you want to look at your utilization of tee times. If you have, for instance, I know, I work at the crossings at Carlsbad here in Carlsbad, and our tee sheet starts at 6:18, and the last time is 3:36. And this past Saturday, I think I worked the closing shift, and there was not one tee time that was open. So that's pretty good utilization. And I think those of you who are obviously everyone here is in the industry right now, or our industry is booming. So really, it's a good time to be in the golf industry if you're doing a business model around this. I was saying the 3 businesses that are thriving right now are Amazon, the golf industry, and McDonald's drive-through. We're all built to last right now. So good businesses to be in if you're in any of those. Anyway, segue aside. So we're going to look at revenues, how much money you're making. Once again, comes down to you can be the best director of golf, the best general manager, the best food and beverage director, the best head pro in the world, in California, and wherever you're joining. If you can't make money for the business, your net worth gets to go very, very low. And I know that's a harsh thing to say, but at the end of the day, the business has to make money. Even if you're a nonprofit, you have to make money to pay the bills. You want to look at cost of goods sold. So you're maximizing revenue from your sales. And I just want to touch a little bit on cost of goods sold coming from a chef background, and I'm going to give you an example. You can have your cost of goods sold, and your cost of goods sold, your budget might be, I don't know, let's say 50%. And you come in at 65%. And someone says to you, oh, well, you're 15% off budget. But you said, you know what? I didn't sell socks and made $5 for a pair of socks. I sold 20 tailor-made drivers, and I made $150 a driver. So when looking at cost of goods sold, don't get too tied up in the percent, because you want to look at the one below that, gross margin. How much money am I making? So from a chef perspective, if I was in the kitchen, I was going to segue a bit. I can sell a Caesar salad for $10, and my food cost might be 30%, and I make $7. Or I sell a steak, and my food cost is 40%, and I make $20. I'd rather have a higher cost of goods sold and make more gross margin than a lower cost of goods sold and not make any money, because at the end of the day, you need money to pay the bills. And so, you know, for those of you, when you're getting into your budgets or looking at budgets, take those two into account. Just because you're hitting the cost of goods sold numbers doesn't mean you're making money, and vice versa. So the metrics, once again, you know, these are all in the handout. You know, you got net operating income, what's left over after you pay the bills. So you bring in the money, you know, you got to pay your cost of goods sold, so your merchandise expense, your operating expenses, so you got to pay for the golf carts, the leases, maybe you got to pay for the, you know, the lights, you know, got to pay for the golf course maintenance. The vertical analysis, you know, vertical analysis, you're comparing two values for the same fiscal year. So cost of goods sold versus total revenue. So I'm bringing all this revenue, but how much am I making? So usually you want to do one divided into the other. Horizontal analysis, you know, usually you go across a specific metric, compare 2 years or more. So you want to look at, here's my green fees in 2018. Here's my green fees in 2019. Here's my green fees 2020. That would be more of a horizontal analysis when you do compare the three. And obviously, you know, in the formula, you add those three and then divide by 3, and that would give you your, you know, difference in percent change, plus or minus. Linear trend analysis, you know, it's up or down from one year or another. Base year analysis, I think a lot of us, anyone involved in writing budgets this year, I know, for instance, if I were to take the Crossing, for example, having a real benchmark year, I always joke with our GM and director of golf, it's going to be tough to write budget next year. So I'm probably going to use 2020 as a base year analysis, because hitting some record numbers, and that's just on our course. You know, all my, you know, friends in the industry around the area, you know, I think all can agree the golf business is booming. So next year, you probably don't want to write your budget based on this year's analysis. And so moving on again to metrics, you got cost of goods sold. You know, you want to look at them as a percentage of sales. Are you increasing or decreasing? And we'll see this in the budget. Cost of goods sold is a percentage of gross margin. You know, how much are we making compared to how much are we paying for the item itself? And are we making, for instance, if we bring in more product and we need more labor to sell that product, are we making more money, or am I just spending more money on labor? So really, it's you know, it's how you want to look at that works into you don't have to do it here, but cost benefit analysis. How much am I spending for how much am I making? And revenue per round. You know, once again, are we maximizing revenue for available tee times? In this, you know, one of the exercises is assumptions. You know, is we got a forecast of changes based on internal and external factors. You know, internal, characteristics. Did we improve the driving range? Just maybe we had a driving range that was short and we extended it. Now people can come and have hit drivers, or maybe we put lights on the range. That's what's increasing business. Did we somehow impact our customer service? Do we increase our merchandise or decrease our merchandise? All going to affect the budget. What financial resources do we have? You know, do we have owners that are willing to put a capital investment that we can forecast more revenue because we built a brand new clubhouse with bank facilities. Maybe we didn't have it before. What, you know, I use staff resources. I prefer employee or colleague. Is that what's the market like right now to hire? You know, right now there are, I think, a lot of individuals that might be out of work. So really it's good for industry, hospitality in general. You know, once, you know, we get out of this kind of scenario for some of the restaurants, but golf courses are booming. There's a labor market to pull from. External really is the market. What's impacting right now? Once again, a lot of people working from home. Interesting, you know, one of the lines I use when people check in is, oh, can I get the receipt? And I said, oh, there's a meeting at the green room today. You know, so who are your customers? Who they're coming in? What's the competition? You know, who are your vendors? And those are some other items. Once again, this is in the slides as well, so I'm not going to spend too much time on it. So you got to validate your assumptions. So for instance, when building the budget, just say you forecast revenue for, I don't know, let's say rounds for 400 and let's say, I don't know, $1 million. Well, you're not going to take $1 million and divide it by 12 and say we're going to get that same amount every month. So really, you want to look at different months, what's happening. So when you're building your budget, January, you know, depending on what golf course you pick, I think this is in the Southwest, so they're usually the open, the weather's good. Probably going to be busy the first week of January, tail off towards the end because, you know, kids are going back to school, people get back to work. Depending on if you look at the private or, you know, once again, public facility, for instance, coming from my background, when I was building my budget, I thought about conference season. You know, one of the facilities talks about they offer Monday tournament rounds. So where the conference season is from November to June or November to late May. When I build my budget, I said, okay, I'm going to increase tournament rounds there because I know it's conference season, and part of my marketing plan or budgeting plan is I'm going to sell tournament rounds on Mondays. Sensitivity analysis, you'll find the definition in the notes itself. But really, you look at best and worst case scenarios. You say, okay, if I make this decision, what's the best case and what's the worst case scenario? I'm going to just say I were to increase my green fees right now. I got the golf business is booming. Best case scenario, I make more money, and I forecast that. Worst case scenario, the golf course next to me undercuts us, their green fees, and now I'm losing business. So really, you run a sensitivity analysis to see how a decision can impact overall operating. The next slide is page 84 and 85. It's creating the budget. So really, you need to forecast the revenue. It comes back to your strategies, your goals. How are you going to achieve these goals? How much are you going to sell? How much are you going to increase by? Are you going to increase by a fixed amount or a percent? Some factors to consider, you know, when looking at the budget is what are the seasons? When is school in and out for kids? You know, what are the holidays? If you're pick the private course and you're writing the budget for it, chances are families are going to be on vacation from the late June to maybe mid-August. So your rounds are probably going to forecast a decrease a little bit. If you're pick the public course and you're forecasting your budget, so you're going to have people on vacation from late June to mid-August, your rounds are most likely going to increase. So that's where you want to look at when you look at the different months. Take into consideration what happens in each month. September, kids go back to school. People not golfing that much. Or you get in December, kids come home from school, so families probably go to the golf course together. And you want to consider those factors when producing, once again, realistic numbers. So I'll give you a little hint if you're doing it. I took my core number, I divided it by 12 across the way, I got divided so it'd be 100% across the 12 months, and then I adjusted each month based on what my assumptions were. So some might be 8%, some might be 12%, some might be 10%, some might be 6%, but at the end, those 12 months equaled 100% of that budget. That's a little shortcut when you're looking at creating that annual budget for yourself. Some factors you want to look at: your expenses. You got fixed versus variable. I know we're closing in on the 5 o'clock. If you want to hang with me till, I promise I'll be done by 5:10, 5:15. Like I said, once again, it's a really robust, probably the biggest chunk to bite here in the entire assignment of the assignments. So it's fixed versus variable, and you'll see fixed is usually, it's going to be the same every month. So you got your rent if you're paying rent, you got the cart rentals if you do those, you got if you got GPS, that's usually a fixed. Your utilities are fixed, you got to pay them. Your director of golf and your salaries are usually fixed. Your hourly employees are variable. Insurance is fixed. So anything that's going to come each month, and it's usually pretty similar or the same, is going to be a fixed expense. Variable expenses vary depending on volume of business. So if you're really busy in July, you need more employees to cart attendants. You need more people working, maybe more greeters, more labor on the floor. So variable adjust according to business levels, and that's a good way to remember that. You're always going to have most likely, a director of golf, probably a general manager, a starter, and let's say a greeter, and so at least 1 or 2 people in the pro shop. Those are going to be fixed. Variable is, I'm doing record numbers, I need to hire more people for the pro shop. Variable are your cost of goods sold. So if you do a lot of sales, then your cost of goods sold varies as well. And when looking at determining, for instance, when you get into the budget, you look at your expenses. There's 2 ways to determine them. You can do them as fixed amounts. So if you're looking at a marketing expense, you say, okay, this year I'm going to spend $500 a month, or I'm going to spend for my employees training and education, my budget is $250 a month. Or the second way is you can do them as percentage of gross revenues. Both have their bonuses, and both have, their, also, I won't say negatives, but both have, sides. So when you forecast your expenses as a percentage of gross revenues, just say you're doing record revenues, and you forecast your employees' education as 3% of your, revenue, you might be in some, really large, producing some large numbers, and as a manager, leader, you're gonna have to reforecast that. So you want to look at what makes sense for the business. This is touched on more so in the exam, less so in the in the assignment itself. What's a cash flow budget? Really, it just covers a small. I'll just go through it quickly. Cash flow is how much cash is coming in. So there's 2 ways, 2 different kind of budgets that are ways to kind of look at how you collect income or revenue. It's the accrual. Accrual is you're going to have revenue maybe come in the end of the month on the 30th or 31st by credit card, but If you don't see that money for another week, well then, you know, you might not be able to pay the bills. So a cash flow budget is all the cash that you have. So if the business doesn't have enough cash, you might not be able to pay the bills. So think of cash flow budget, follow the cash. It comes in, this is how much I have in the bank. Here's what the bills are. Can I pay the bills with this amount of cash? It does not include credit. Credit becomes cash when you receive the money, and it goes in the bank account. So one of the one of the questions that you might see would be, how can you mitigate? Being able to pay your creditors is that you establish a line of credit. I'll touch on this quick as well. So you got capital budget, otherwise known as CapEx. CapEx is when you're creating a budget based on a major purchase, whether it's equipment, whether it's an upgrade to the facility, to the buildings, to the golf course. And a good way to remember what a capital budget is it gets depreciated on the balance sheet. Might be a little bit more for what you need, but when you think about it, so you got your operating budget is what you need to make the facility work every day, every month for the year. CapEx is we're buying a fleet of mowers, and those will go on the balance sheet, and each year they depreciate. Just like if you bought a car, it depreciates. Operational expenditures do not depreciate on the balance sheet. So we had to buy, we had to buy a new racks for the clothing in the pro shop. That's an operational expense. We had to buy new dishes for the dining room. So really phase 4, we look at what's going to determine annual budgets based on the goals. So they got to be realistic, they got to be timely. For instance, the budget's going to be annually. And that supports the mission and vision. Back to phase 1. Run the sensitivity tests and forecasts, your monthly revenues and expenses based on internal and external factors. And I'm just going to bring these up quickly so you can see. Here's some assumptions. So for instance, so if I look at what my assumption is, here's what's going to happen. The rationale is I'm going to hit this number because of this. So basically cause is the assumption, the effect is the assumption. The cause is the rationale. How come it's going to happen? So when you're looking at an assignment, think of that. Assumption is I'm going to do this. And then the rationale is I'm going to do this because we're doing this as a facility. And there's a few examples there. And like I said, this one, assignment 4 is one of the biggest ones. We got, so here's 4B. When looking at it, you're going to go across, here's year 5 when you're forecasting. Yeah, year 5, you got your numbers, and then, some of the numbers are already in. The average change, so I did that horizontal analysis across a couple of years, year 3, 4, and 5 to get to 6. I found out this, then I had to figure out what my budget was going to be, and that's the trend. But I reforecast it for this. So it depends on what golf course you pick, and is this number that you revised, is it tie in to the objectives, the goals, and you have to have a rationale how you're going to achieve that number. So my goal was, okay, I started at 69,545. Well, I didn't start with it, that was the number. The trend was it's going down, or the tournament fees were minus 20%. So one of my goals was I was going to increase tournament fees. So there's the trend, and I'm sure it's covered there. So the trend would have been that, but my goal was to increase that. So when you're looking at that, That's what you want to go through in your budgets. Now, everything can't increase. Some things might decrease. But you got to remember, at the end of the year, your number that you reforecast, you can see my cursor on here, has to be higher than the year before. You don't want to be forecasting lower. So some of your categories can be lower because, just say you had a benchmark year in that, but you always want to be making more money. And then you justify that through your goals, objectives. And there might be some instances where you might want to decrease or keep the same. You'll see utilities. They said I think they say in the notes, they increase by this much. So you got to increase some items by, what, the book says they increase by. But when you look at it overall, everything has to make sense, and you want to find ways where you can increase revenue as the, as the director of golf. So I picked Summit Valley. If you pick Crescent Ridge, once again, look at your vertical, look at your horizontal, plug in the formulas, and then and that's how you get your budget. Now, and you'll see the different changes in percent here. Some have decreased, as in this -1.5. I decreased education and travel, and I decreased the merchandise gross margin, but that was because of some factors that were in the case study. But then some of the numbers I looked at increasing how it's going to drive revenue as well. The second part of this assignment is the 4 C's, the annual budget. So you look at tournament fees. So that was pulled. So you saw before I wanted to go to 75. So I looked at, when we spoke about the factors, the months, you'll see is that, these are pretty even. And then I drop a little bit in March. April goes up, conference season. May goes down a bit because I know it's a tail end of conference season. June, July, going to drive member tournaments then. August. Oh, sorry, and the guest tournament fees just underneath. Sorry, that'd be more conference season. So guest tournament fees, I wanted to increase. And I did that based on, I know these are the times when we can, want to fill the course. And, you can look at July and August when you have those fundraising fees, fundraising tournaments. And that's a good way to look at that. Some of them stayed the same. So locker usage, I kept the same throughout the year because it's, that's the one. It's not going to really increase or decrease unless you bring in 50 more members and have a certain amount of more lockers. So really just look at each as a whole and, deciding factors on how each are going to increase or decrease. And so that was my my assignment there. And so this is the last one. Once again, thanks for staying along here. I know we're running a few minutes longer, but once again, like I said, it's quite this one, the business is quite a one to take on. So this one is going to be short. This is monitoring performance. It's one of the smallest assignments in the business planning. It's monitoring performance, and when you're looking at it, is really when you look at the numbers, how are you going to get those numbers? So you're going to look at actual versus forecasted. Did you forecast too high when you looked at your budget? Are they reasonable? Or for instance, the weather impacted it. It rained all December, and now my numbers are shot for all of December. So maybe I need to reforecast my first quarter. Do I need to look at reducing my expenses? Do I need to find ways to increase revenue through promotional activity? And, this is part of that assignment. Do I need to decrease labor? Once again, it rained all of December. I need to decrease labor so that my expenses are at least a little bit in line with the revenue that's coming in. And then you could be on the aggressive side and you can introduce promotions, to fill any unfilled tee times if you have them, as one example. Some metrics to use. when finding your actual versus forecast, once again, it comes down to your rounds, your yield management. Are you getting as much play as possible? Revenues per round, cost of good as a percentage of sales, your gross margin as a percentage of sales, and what are the tools you can use? Tools you can use the POS system, point of sale. Use your sales reports. Use your monthly, quarterly, and annual budgets, as well as previous year's budgets. I think, I spoke about before. Next year, if business is still booming like this, okay, this year would probably be a good analysis. But if next year we get back, knock on wood, hopefully a little bit more normal, globally, you might not see those record revenues come in. So you might have to work off the year before to really get a realistic budget for the following year. A way to do this as well, you do SWOT audits, pick a specific area, in the business, or just secret shoppers, and see if really you're meeting those goals and objectives. And the last, we got, if you're responding, you got underperforming budget, might have to revisit the annual budget and look at reforecast in certain areas. You might have to adjust pricing structure. Maybe you took an aggressive line and increased the green fees, but maybe you need to put in a promotion now because you might have outpriced yourself. Increased revenue through promotional activities, or once again, reduced expenses to align with increased revenues. And that's kind of it. Thank you very much for your time. And just if you're wondering, coming from a little bit of academic background, I did reference at the last slide. So if there's anyone from academia there, I did reference all those slides. So no plagiarism here, just if you're wondering. And
Jeffrey,
yep.
Phenomenal, absolutely phenomenal. This is going to, I was just texting Tom's son on the side. This is going to make a great reference on the SCPGA website under the Launchpad Educational Associate Assistance Guides. Thank you so much for putting it together. I don't have any questions from the three attendees. Tom, do you want to jump on and say a few words about next week?
Yeah, Dr. Silverstein, I think, had a question before I don't know if he's in the call right now. Maybe he is or isn't. Do you see him on the call, John, or no?
Yeah, no, he's there, but he hasn't. There's no questions from him.
Okay.
Dr. Silverstein, are you still with us? He may have.
Yeah, maybe Jeffrey's presentation was so detailed that.
He's got his hand raised.
Okay.
Go ahead, Doctor. You got the mic. Sai, it's all yours. You're unmuted. That's strange. Doc, are you there? All right, he's not typing in any questions, but he is unmuted. But he took himself off mute.
Oh. Anyways,
Doc, are you there?
Maybe Doc could follow up with Jeffrey one-on-one after the call to ask any specific questions that he may have. But basically, echoing what you said, John, this was a really awesome presentation. Jeffrey is going to be a PJ member soon, but is still in the program. I felt like he was the best person to present this very complicated and long-winded section because of his.
He most certainly was. He most certainly was. I didn't know that he was at the crossings at Carlsbad with Tate. You'll have to tell him John Kulo said hi.
Certainly will.
So
Tate and I go way back.
So I thought it was a phenomenal job he did today. I think this is something that we should try for the standard. Next week, so thank you, Jeffrey, for all the preparation. You put a lot of work into this. It's very obvious that you did, and we appreciate it. And hopefully, the three associates who are listening on the call are also very appreciative of your time and effort today. So thank you again, Jeffrey. Next Monday, it's Michael Gainey on player development. And lastly, Kyle Mendoza on November 30th on coaching. So we have 2 more Launchpads coming up next 2 weeks, and that'll be the end of the first Launchpad for level 1 for 2020. And John and I will plan for 2021 accordingly. So again, thank you, Jeffrey, so much. It was wonderful. It's great presentation, and hopefully it was helpful to all 3 associates. And it'll be available so other associates who cannot make this call could use it for their benefit in finishing this difficult section of the level 1 portfolio.
Well, if anyone,
okay. Sorry.
I was going to say, if anyone, you know, wants to reach out personally, just let them know. You can share my email, and I'm more than happy if anyone, you know, wants a personal walkthrough, any of the, you know, how to get through. I guess probably the budget one is the biggest stake to bite into, I'll say. Just, you know, determining numbers, and so please, if you want any assistance, reach out, and I'm more than happy to set up time to coordinate.
In order to do that, Jeffrey, can you just right there on your screen, just pop open a new window and type in your name, your contact number, and your email, because whoever watches this presentation off the website will be able to grab your contact information off the. I don't think you showed it at any point in the presentation.
Okay, here, I'll just open up a Word document.
Exactly. Just type it in there, and email and contact phone number, and that's all. That'll all you need to do. Is that a Canadian phone number there?
No,
You got one.
I got the Canadian accent, but not the phone number.
Right, you got
Oh,
in that
sorry.
first set of 3.
Oh, sorry. Yeah. There we are.
Perfect. No, that's great. All right, I think that's it. Tom, you have anything else?
No, John. Thank you, everyone, for joining the call. Thank you again, Jeffrey, and we'll speak to you next week.
All right, Dr. Silverstein, Michael Duncan, Hannah Faccini, and Mr. Leone, thanks for being with us again, and we'll see you guys next week. Thanks, Tom. Take care, everybody.
Bye-bye.